Welcome back to Beyond the Benchmark, the podcast where we break down markets, money, and the forces reshaping the global economy. I'm Brad Casper, and today's episode is titled When Gold Calls Out the Lie. Because let's face it, markets can tolerate illusions for a while. But gold? Gold doesn't lie. And in 2025, its voice is deafening. Gold's warning. Year to date, bullion has surged more than 35%. Gold miners, nearly 90%. We're staring down the strongest calendar year for gold since 1979. Another moment in history when deficits, inflation, and geopolitical fracture collided. But gold isn't just rising, it's broadcasting a warning. And the message is simple. Trust in government promises and fiat stability is eroding. Now markets love to ignore signals. They love to rationalize and push back the moment of reckoning. But eventually, the truth becomes impossible to overlook. Right now, gold is shouting, and investors need to listen. The collision of two forces. Here's what makes this moment different. Two tectonic forces are colliding, and they are not in harmony. On one side, we have fiscal excess, record deficits, ballooning debt, central banks caught between inflation risk and political pressure. It's the same movie we've seen before, only this time the stakes are higher, the numbers bigger, and the willingness to address them weaker. On the other side, we have extraordinary innovation, artificial intelligence, a once-in-a-century technological shift, the kind that rewires productivity and resets the growth outlook. It's paradoxical, isn't it? One force erodes confidence, the other inspires it. One undermines the foundations of money, the other builds new scaffolding for commerce. And yet, they coexist. This is our reality, and portfolios that ignore one side of the equation or lean too heavily into the other will be caught flat-footed. Gold's timeless role. Here's why gold matters in this storm. Gold has no central banker. It doesn't default. It doesn't dilute. It doesn't delay payment. Alan Greenspan put it perfectly back in 1966, long before he became Fed chair. He wrote, "Deficit spending is simply a scheme for the confiscation of wealth. Gold stands in the way of this insidious process. It stands as a protector of property rights." That was nearly 60 years ago. It could have been written yesterday. And central banks seem to agree. For the first time since the mid-1990s, they hold more gold than U.S. Treasuries as a percentage of reserves. Private investors are following their lead. Over $25 billion has poured into bullion ETFs this year, with record daily inflows into gold miners. Silver and platinum are rallying in sympathy. This is not just about protection, it's about participation. It's about owning the one asset that transforms fiscal excess from a threat into an opportunity. But let's not forget, excess is not the only story. Innovation matters too. Artificial intelligence is not hype. It's real. It's a general-purpose technology on the scale of electricity in the 19th century or the internet at the turn of the 21st. AI is compressing inefficiencies, accelerating productivity, and rewriting the playbook for growth. And it's not arriving alone. Blockchain and decentralized systems are evolving in parallel, offering programmable money and digital trust to complement machine-driven commerce. In that world, gold protects wealth in the physical realm. Bitcoin protects it in the digital realm. Both act as anchors in a time of transition. The 60-40 illusion. So what does this mean for portfolios? It means the old 60-40 model, the bedrock of traditional investing, is no longer enough. That framework was built for a world of low inflation, stable geopolitics, and reliable diversification between stocks and bonds. That world is gone. The illusion has been shattered. Deficits are too big, inflation too sticky, geopolitics too fractured. The architecture of the future portfolio requires different beams. Stores of value like gold and Bitcoin, transformational growth engines like artificial intelligence, energy solutions that balance today's reality with tomorrow's needs, fossil fuels now, nuclear to stabilize, renewables to bridge. This is the new foundation for resilient investing. Let's frame this in the context of today's market action. In August, U.S. equities managed to grind higher, though international markets outpaced them as a weaker dollar shifted momentum overseas. Bonds caught a bit of relief with lower yields, though widening credit spreads told a different story beneath the surface. Commodities were mixed. Oil softened, copper steadied, and digital assets cooled after a wild summer rally. But all of that is secondary to the big signal. Gold sits above $3,500 an ounce. Uncharted territory. That's not a blip. That's a megaphone. This is not a bearish episode. It's not doom and gloom. It's realism. The clash between government excess and technological revolution will define this era. Investors who adapt, not cling to old models, will not just survive but thrive. Ignore gold's signal at your peril. It is telling us deficits matter, debt matters, trust matters, and gold will not let us look away. That's it for episode 2 of Beyond the Benchmark. Gold doesn't lie. It never has. And as we look at the next decade of investing, the question isn't whether you'll listen, it's how you'll respond. Thanks for joining me today. If you enjoyed this episode, make sure to subscribe, share it with your network, and stay tuned for more conversations that cut through the noise to focus on what really matters for your portfolios and your clients. Until next time, I'm Brad Casper, and this is Beyond the Benchmark.